Hi, everyone, and welcome to the Amber Data Derivatives podcast. I'm here with Simran Singh, who is the CEO and co-founder of Monaco, and he's also got a background at GSR and Goldman Sachs. Simran, how are you?
Well, thank you, and thank you for the opportunity, Greg.
Yeah, we've been in touch for quite a while now. We've worked together for quite a few years, and you've been a huge presence in the vol space, in the crypto vol space. So it was long overdue, and I'm very happy to have you on. I thought maybe we could start a little bit with your background. You started at Goldman Sachs, professionally trading, I believe, crude oil vol, before
Yep.
going off to GSR and really getting in the crypto space. So maybe you could just kind of walk us through that. How did you get started trading and trading vol in particular?
Sure. Yeah. So I graduated college 2017 and hit the desk at Goldman. Initially, first in a risk management role, and then soon you realize that the truest form of risk management is when you're in a trading seat and get to experience this full force. I like to say the first white hair I got in my beard was when oil went negative, which was,
Oh, yeah.
once in a lifetime is one thing, but once in history is another kind of phenomenon. And it's a testament to the fact that all models are wrong, but some models are useful. And when you're forced to really adapt to those conditions, it's quite incredible. And so during that time, I got to call oil producers, airlines, hedge funds, you name it, and really gain appreciation for what makes oil prices move and how people speculate, how people hedge, and how those market forces kind of come together. And then later on, I transitioned to GSR, joining the crypto market maker in 2022. First, thinking about other business lines in addition to token issuer market making. So, staking as a service, tokenomic design, NFT trading, and leveraging my background on the trading side to help build out those product lines. And then was most recently heading up DeFi trading at GSR, where it was really about porting over existing strategies that we knew that worked on centralized exchanges in CeFi, and working to bring them on chain and capture arbitrage wherever opportunities were possible.
Yeah, that's fantastic. I definitely want to dig into the oil going negative. So that was quite an eventful time. I think it was April 2020, if I remember right, and we
Yep.
had the front month future because there
Mhm.
was no place to store it. The cost of storage created the contract to become negative, and so no one wanted to take
Mhm.
delivery. People were willing to sell. I remember seeing it bounce off a penny and then trade as low as I think -11 or -$19. CME started listing negative strike prices. What was that like? I mean, was it? I mean, this is Goldman. This is a huge desk.
Mhm.
You're trading vol on that market. How does? I mean, that breaks the models, right? Black-Scholes
Yep.
model, Black 76 assumes log normal distribution, which
Mhm.
essentially breaks if zero is no longer bounded. How did you guys adjust that? I mean, how does everything change?
Yeah, sure. So I would say it was that kind of phenomenon was a convergence of a few things, right? One was you had this global supply war where Russia, Saudi, and other oil producing countries were simply saying, hey, we're just going to literally try and undercut each other. And so it was a race to the bottom. You had a over supply issue effectively and no place to put the storage. And you had this phenomena of a global pandemic. So demand was absolutely destroyed, right? And oil specifically, it was WTI, which is landlocked, which is the type of crude that went negative. It actually settled negative 37.63
Wow.
on the day. It's like that number. It's hard to forget when you're sitting on the desk and you're like, oh my god, this has never happened before. And you rightfully called out a lot of models will break because when oil goes negative, they actually switch to a normal margining model. I believe it's called Bachelier, to model these price moves as opposed to using log normality. It was it was an incredible learning opportunity, and it was very much a trial by fire. Some market phenomenons that we observed, right? The front month liquidity pretty much dried up. It was actually easier to trade volatility a year out than it was to trade front month because the market makers on the screens just became wider than the Grand Canyon. I think is the best example I can
Wow.
give, where no one was really willing to provide short-term gamma or provide liquidity in the front month. You had a bunch of, I would say, oil producers who were strapped for cash and were forced to unwind positions that were in the money, and they were willing to take steep haircuts because they needed the cash today, as opposed to being in the money and trying to monetize those positions a year from now. So the convergence of like the fundamental story, global pandemic, all kind of came together to produce this phenomena. And being able to sit there at the heart of an oil desk and quoting sovereigns, producers, you name it, was a very invaluable learning opportunity.
And were you guys just kind of facilitating flow, or did you guys have any like prop positions on that you guys were managing as well?
Well, Greg, I mean, banks are not allowed to prop trade. Come on.
Or principal, I
But
should say.
Yeah, I would say there was an expectation that there was going to be heightened vol. You rightfully called out that the first negative strike put options had begun trading maybe a week or 2 weeks before then, which was kind of confirmation for the market that, hey, CME will let you actually have negative strike settled futures. I think there was certainly a view. We had desks out of Singapore that have a more aggressive risk appetite, that had some directional exposure in the context of the broader portfolio. But my job was mostly just focusing on flow management and making sure that, hey, if I have a 35 delta and someone's got a 65 delta, we're risk managing that basis quite well when it comes to actually putting on options trades.
Yeah, that's fantastic. What an interesting time to trade um, oil vol. So kind
Yep.
of moving on from that. So after Goldman, how did you transition into crypto? Like, what was the spark to get you to go to GSR?
Sure. So I dabbled back in BTC, I want to say back in 2017, where there wasn't much else to do besides trade Bitcoin. And it was really the Uniswap V2 white paper that made me be like, oh, they took a hyperbola, XY equals K, and made a market out of it. And like, what is it about this space that's attracting so much talent? There was a Cambrian explosion of DeFi summer. And so all these folks flocking to the space that was still novel really made me think. I'm just like, well, if all of this goes to zero, I can always go be a quant trader and researcher somewhere else. But if I get to be a small part of something much bigger and markets are still inefficient and I can play some role in helping forge them and be a participant, then that feels like a pretty good convexity play. And
Mm.
viewing most things in life as an option, some people view it as a cold way to view the world. I view it as a blessing because it makes life and decision making a lot simpler. And so for me, this was a intellectual curiosity motivated by, I would say, an opportunity to monetize. And GSR was, and still is, a leading market maker in the space, I would argue. And there was the pedigree of having been founded by founders that were also oil traders at Goldman, the G and R of GSR. And so I joined in 2022, and I would say I probably top picked the market, right? I think 2021 is when like DeFi TVL had been the highest. I joined, the firm was expanding, the industry was still growing, but then you begin to see the signs of overextension, which led to a very fun next 3 years of my time in crypto.
Yeah, we had the FTX, we had Terra Luna, we had Three Arrows blowing up on the grayscale trade.
Mhm.
Those are all kind of interesting things.
Yep.
Then we had this massive recovery,
Mhm.
and today, today is quite a down day. I think Bitcoin's down 9%, 10%. Devol is at 74.
Mhm.
That's kind of an interesting time. But how do you view like the crypto vol trading space and making markets there compared to traditional finance? Is it very similar? Obviously, you went into DeFi as well, but I think GSR was a big player in Deribit and some of those
Mhm.
traditionally listed exchanges or CeFi exchanges. Is that a very similar experience to TradFi market making, or is it different, or what does that look like?
There are certainly some similarities, but I think the probably the biggest difference really comes in why people trade these derivatives, right? Uh, in traditional asset classes, and I actually had published a piece about this a few weeks back, why altcoin options, for example, haven't taken off as much in crypto, right? In traditional asset classes, there are natural buyers and sellers, right? And
Mm.
going with the oil example, it's like oil producers are naturally long oil. They need to hedge their downside, so they buy put options, sell call options, enter into these structures that hedge their downside. Then you also have consumers, you have refiners, you have airlines that are effectively taking the other sides of these trades. And then you have a bunch of speculators, whether it's macro funds or anyone else, that simply want to express a view on either term structure, volatility, fundamental mispricings, and regional dislocations, right? So there's this hodgepodge of things that leads to interesting phenomena to happen and to have a healthy market. You also see this in equities, you see this in rates and FX. In crypto, I would argue that just given the early adoption of participants, a lot of that flow has just been dominated by retail, and you find that retail appetite is so prevalently met by perps
Mm.
that who in their right mind would be like, oh, let me pay 30 vols of bid offer in order to get this convexity if all I want is linear exposure. And so I think fundamentally appreciating that the flow tends to often be one way, and things like yield carry or vol carry in the form of covered calls, cash secured puts tends to be the dominant form, right? And I think that was kind of the 2021, 2022 inning. Then you begin to see this long drawn out period of low volatility. I still remember there was this ETH call overwriting program that happened in 2023, which was like one of the largest vol selling programs that ETH had ever seen, which isn't saying much because the market was still nascent, but it really shook the market because there was such little flow. And then I think 2024 is really when you begin to see the, dare I say, commodities like behavior of crypto, right? Where you think about gold, where you can actually have positive call skew. Most people who
Right.
come from an equities background are just like, oh, well, yeah, puts should trade over calls. People value downside protection. This makes sense. But then when you think about precious metals, where you can actually see rich skew to the upside, you begin to see very similar phenomenon in BTC and ETH. This was specifically around the news for the Bitcoin ETF announcement. You also saw interesting things happen when the merge was happening, the fundamental change for ETH infrastructure. And so, like, all these little events were leading to interesting market microstructure and idiosyncratic dynamics. And I think that is now continued as you begin to see like liquidity in spot ETF options markets. And I
Yeah.
would argue that spot ETF options markets are honestly on par, if not sometimes exceeding what you see in native markets, the likes of Deribit.
Yeah, it's really interesting. And so, sort of the flows, I mean, it's been my thesis, and I'm sure a lot of other people's thesis, that the flows from the traditional side really are kind of like that call overriding type of flow, maybe some put buying, which is what they do with equities or any sort of risk on portfolio. And it's kind of what we've seen since the launch of the IBIT options.
Yep.
Vol consistently grinding lower, and then the long dated risk reversal flipping from positive to negative, meaning the puts were cheaper at first and now they're more expensive structurally. Um,
Yep.
does that create an opportunity for the crypto natives, or is that dominant flow right, so to speak?
I would say it's very similar to what you see in other asset classes, where like vol selling in general tends to work until you see like the convergence of just enough factors to rip people's face off.
Yeah.
Right? Like for example, if you were just massively call selling ahead of the ETF announcements or the Trump election, or even ahead of like dare I say the debasement trade, right? Like these things worked until they don't, and then you see these sharp moves the likes of gold, silver, and even what BTC had briefly before you see this massive retracement over the last month or so. I would say like the flow is simply driven by the fact that why should people hold this asset, right? I think like if you view it in a macro context and viewed as a store of value and put it in the same category as gold, like fine, okay, that flow is misguided and people should simply be thinking of it as a store of value and dare I say accumulating it. And you still see central bank buying of gold, right? Even at the highest of levels. So one could argue that gold, BTC should have very similar behavior. But the truth of the matter is that institutions are still, I think, hesitant to adopt Bitcoin as a standard store of value. And because of that, while that remains the case, I think covered call is programs are not going to go away anytime soon.
Yeah, so the traditional investor views it as a risk on asset. And we've
Yep.
seen, I mean, if we overlay the software stock ETF versus Bitcoin, the chart looks almost identical.
Yep.
So it's being treated as a risk asset. And so if you view it as a store of value, you're kind of um, outside of the how it's being priced. Right, your view is not the
Yep.
standard one, but maybe that changes in the future. We'll see. Who knows? Okay. Was there any kind of tradition, not traditional, but like reoccurring opportunities in sort of the delta neutral space that you would see in Bitcoin vol or sort of Bitcoin funding, like fixed versus floating type of
Mhm.
trades or anything like that? Is there anything that a trade that
I
you
mean,
like a lot?
I tend to simply I tend to like vol carry, so long gamma, short vol, in specific market environments. And the only reason is because like when nothing is happening in the market, nothing tends to persist for extended periods of time. So you pay a little bit more theta, but then the vol compression happens. But then when you have idiosyncratic term structure events, right? Like I think elections are one of them. The gamma really pays off when you need it. So I think just more often than not, the contango vol term structure tends to lead to a nice vol carry, is what I would say. And you can strike that to be delta neutral if you really want. Outside of that, I tend to like 1 by 1.5 and 1 by 2s where I'm owning the wings. And very much for a similar thesis, right? Which is like on average, I think vol is fairly-ish priced, but can get elevated at times. But it's really on the wings that you want to have that protection.
Interesting. And so, speaking of sort of the vol carry trade, is that like a diagonal structure? You're long sort of the short dated one, and then short sort of the long dated option, so short Vega, and then kind of long the gamma side. Is that kind of how you would structure
Yep,
that?
that's exactly it. Long the front, short the back. So long gamma, short vega.
Yeah, very interesting. And then the hope there is that vol picks up, and then that term structure kind of flattens, and maybe that
Pretty
the vol
much.
component doesn't matter too much if the underlying is kind of moving nicely.
Exactly, right? The vol of vol, just to go second order for a second, the vol of vol of the front tends to be much higher than the vol of the back. And so you can size it in a way where as that vol compresses, the incremental benefit of just owning the front and being just pure gamma is kind of the play. And what's actually interesting, if you think about it, think about how much of the volume in traditional like equities markets or index vol is just zero DTEs, right? It's dominated by just people trading the front. And now with the emergence of like these 15-minute markets on Polymarket, we're realizing that most people really just want to express very short dated views, and kind of gamble with maybe some term structure effects. But that's where like the interest in, I think, the front part of the curve really comes in.
Yeah, that's fantastic. That's super interesting.
Yeah.
And then, kind of in terms, just going back to commodities real
Mhm.
quick and negative oil. So we talked about
Mhm.
precious metals. We touched on it briefly. I mean, we've seen precious metal. I mean, I think silver vol right now, the 30-day VIX calc is around 95. I think gold's around 36.
Mhm.
I mean, 95. That's ETH and Solana volatility, and ETH and
Yep.
Solana have come from zero to thousands of dollars. So the
Mhm.
silver has not done that in a long time. So that type of vol, I mean, it's quite expensive. Do you think? Do you think that's justified? Is there a risk right now? The chatter is, does Comex have the physical to deliver? And if they don't, do shorts just have to buy this thing all the way up to thousands of dollars? Is that thesis something you subscribe to, or do you think this is kind of business as usual and maybe there's a vol sell here? How do you view that?
I think the first leg of the journey, I think, was simply a continuation of central bank buying and people realizing like, oh my God, the debasement trade is actually unfolding. It was unfolding slowly and then it accelerated. Um, And I think the second leg was really people then piling into the trade, especially like uninformed retail who sees a flashing headline, and then wants to dive in, which then tends to dislocate paper markets and leverage from the physical market. I think a lot of people were quoting just the arb between Shanghai and CME, for example. As to whether COMEX has the spot like a spot silver or not, like I am not a metals expert by any means, but I tend to be dubious of people saying like the physical market, like the paper market is much bigger than the physical market, but it's one of those things where if you're going to take on a position, like yes, you're taking some level of credit and counterparty risk to the underlying venue, but then that's just the price that you pay for engaging in such a speculative market. I think is the short answer.
Yeah. Now imagine if they don't have the asset, like shorts just have to buy back because they can't
Yep.
deliver. That's very interesting. One of the things that's, and maybe you have an opinion here. I know we're kind of moving away from crypto, but I'm just
Mhm.
curious on your thoughts. So a lot of the narrative around precious metals is the debasement. The thing that's not adding up to me, however, is that if it was a debasement trade flow, so for example, like I think the
Mhm.
US dollar is down 15% since 2025, since January 1st, 2025. Gold is up like 100% and silver is up like 300%. But
Mhm.
what's interesting to me is that with this whole recent move in precious metals, we're not really seeing like the 30-year bond move. Like the
Mhm.
yield is sticky. I would imagine if it was the basement trade, the last thing I would want to own is 30-year paper. Um,
Yep.
and so, what do you think that's maybe a contradiction of shorts to the debasement trade thesis?
I think it's a reflection of the fact that a lot of the noise around debasement is honestly a reflection of administrative policies rather than long-term fair value. I think is really the short answer. I think if this was going to be a long-term thesis and predicated on the idea that, hey, like the US dollar is like forever going to fall, or like over the next 20 years is going to remain quite poor, then I think you would expect to see that reflected in the rates curve a lot more. I think this is honestly just more of a flash in the pan that is now retraced with the advancing of a more hawkish Fed.
Yeah, interesting. So in that case, I think the vol sell is pretty interesting on the silver
Yeah.
trade. Yeah, interesting. Cool. Okay, so you mentioned at GSR, one of the things
Mhm.
you were heading was DeFi trading and replicating some of the strategies from CeFi to DeFi.
Mhm.
Kind of, what's kind of the structure there? What was the thought and sort of the strategy in the process?
Yeah, sure. Well, if you really think about it, AMMs, you can view them as a novel innovation. I think they're a pretty cool structure, but still remain capital inefficient. But at the end of the day, an AMM is really just a continuous order book with limit orders and some idiosyncrasies around minting and redeeming positions. So simply porting over what we were doing at the HFT side of things on the Binances, the Coinbases of the world, and applying them to AMMs, and then also running cross-venue arbitrage was just kind of the level zero of what we were focused on. Outside of that, I was thinking about things like incubations and like what does the broader DeFi industry look like, and then serving as a sounding board for volatility products, right? And I think even if I look back over the past 3 years, folks have tried to launch structured products in crypto on chain, and it's one of those things where I'm like, I coming from a derivatives background, love that concept, and I'm just like, oh, I wish these kinds of things take off. But ultimately, if the underlying market is not sufficiently liquid enough, then no amount of esoteric exotics are really going to be able to survive if there isn't sufficient demand.
Interesting. So you guys were
Mhm.
focused on sort of the Delta One aspect of DeFi. What about
Mhm.
like sort of the DeFi venues like Deriv or
Mhm.
Avo for trading options or perps and things like
Yep.
that, hyper liquid?
Yep. So I would say AVO or any sort of other DOV like risk finance, for example, was quite interesting and just another form of gamma. Like that tends to lend itself to a more OTC style execution than anything fully on chain. In terms of Derive, previously called Lyra, if I'm not mistaken,
Hmm.
I've had many conversations with them. I do think it's a very interesting paradigm and structure to differentiate. And there were certainly a few opportunities for cross-venue arbitrage between that and Deribit pricing. But when there is a mismatch, I would say, in like volume and liquidity profile, even if that ARB is there, the capital intensive nature of having to quote on two markets,
Yeah.
I think tends to be a binding constraint, right? Like an ARB is only as profitable as your ability to monetize it. And if either it's not there in size or it's very punitive from a capital cost perspective to do it, then it's probably not worth it.
Yeah, interesting. And so after doing this at GSR for quite a few years, what brought you to found or co-found your own company and lead that called Monaco? And what does Monaco do? And can you give us a background of it?
Yeah, sure. I as for kind of how I found Monaco, I would say it's a combination of a few things, but ultimately the market as I see it in terms of what is addressable is not really these offshore permissionless trades that happen, right? I think Hyperliquid is a very good product, Lighter is a good product, but the name of the game is actually how do you tap into a 69 trillion market cap, a little bit lower now today given the market sell off, or how do you tap into an $8 to $10 trillion retail commodity volume or $3.5 trillion private credit market, right? The key distinction, I think, is taking a regulated first approach, taking a compliant first approach. And so Monaco, you can call it a global trading network, a liquidity layer, a central limit order book, is very much a decentralized exchange founded on the premise that if you simply want to trade crypto assets, you should be able to do so in a permissionless way. If you want to touch regulated tokenized securities or commodities, then the name of the game is very much going with a KYC, KYB, genius compliant first approach, right? And there's a few ways that we do that by partnering with industry standards, but then also thinking about, well, why have things like tokenized equities not taken off previously? You could argue it's because, people don't want to take SPV risks to these abstracted versions of tokenized assets. But the truth, in my opinion, is until we give people incremental benefit of holding tokenized NVIDIA on chain in the form of being able to borrow against it or lend it out, or dare I say, post it as collateral, why should people even hold it on chain when they can just lend it to short sellers on Robinhood or interactive brokers,
Mm.
right? So I think utility has really been the missing piece. As for why now, I mean, you already see the NASDAQ and NYSE moving towards 24/5 and 24/7 markets respectively and adopting the tokenization standard, right? So the on-chain economy is not just coming, it's already here. And being able to kind of sit in the center and convergence of CeFi versus DeFi is what Monaco is very much about.
And so, do you believe, independent of Bitcoin prices or crypto
Mhm,
prices as a whole, really financial
mhm.
infrastructure is going to be migrating towards blockchain technology?
Never and always are two words you should always remember to never use. That said, I think there's a 99 delta of this.
Yeah, interesting. And
Mhm,
so, okay, we've talked about sort of the lacking components of on-chain equities right now in terms
mhm,
of utility, in terms of using them as collateral, and so on and so
mhm.
forth. What would be the benefits, in your view, of tokenized equities and sort of that world migrating to blockchain technology?
Yeah, sure. I think one really evident use case is when you have macro events unfold and all other markets are closed. Crypto is the first to take a dump, right? You see this, I think, during the yen carry unwind of 2024, if I'm not mistaken.
Mm-hmm.
And so, yeah, on the weekends, whenever these macro announcements happen, when people want to go risk off mode, they just express it in crypto terms. But as you move towards more 24/5 and 24/7 markets where these securities are accessible, one, I think it actually reduces overall systemic volatility because now you can actually avoid that gap risk of, oh my God, markets are closed on Friday. And even with extended hours, I have to wait so much time before I can actually express a view. So reduction in volatility, but then also increase in capital efficiency is the no-brainer, right? You have well-established risk management tools like SPAN and SIM, which are industry standard that centralized exchanges and OTC clearinghouses use for margining, thinking about how much capital we should have on hand for derivatives positions. And if you move to a fully on-chain market, I think margining becomes a lot more easier. You can do it in continuous time. You can be more customized as for what is eligible collateral. And like capital efficiency and risk management are the core bedrock of what drives a lot of these like large-scale institutional adoptions. And being able to do that fully on-chain, I think, is a no-brainer and inevitably the right answer.
Oh yeah, fantastic. And so is Monaco, in
Mhm.
beta? Is it launching? I mean, what's kind of the timeline? What's the roadmap? What's the initial product, and what's sort of the future product in your vision?
Sure. So the initial product is a central limit order book that'll support spot, perps, prediction markets. We're entering private beta over the course of the next few weeks and working with a few different front end partners who are all catering to different trading styles. Right. I think the name of the game is you want to create a customized, tailored experience for people to be able to access markets in whatever their respective trading style is, while still accessing a shared liquidity layer. And that's where the benefit of multiple front end partners comes in. As for where Monaco will go from there, I mean, we're going to probably roll out, I would say, mainnet by the end of this year. We're working to finalize industry standard partners, whether it's tokenization partners, compliance partners, you name it. But yeah, excited to be building Monaco properly.
Yeah, that's fantastic. So it's going to be essentially a flexible central limit order book in a sense that it can support multiple types of assets, prediction markets,
Mhm.
tokens, tokenized stocks. Does the central limit order book require a risk engine as well with each one of these, or does the exchange run the risk engine and use kind of like lease out your central limit order book to essentially clear
So
trade? How does that work?
sure. So we are the exchange on central limit order book, right? That is the protocol itself. I would say the risk engine is one of the most important, if not the most important pieces of building a very successful product like this. I think even Yevgeny was posting about this yesterday, where he said, people talk about throughput and latency as if they're the final roadblocks for the umpteenth perp decks. But the truth is, like risk management and building a proper risk engine is actually what is the massive unlock, right? How do you think about ADL? How do you think about bad wigs? How do you think about liquidity? And a lot of these lessons TradFi has actually learned 20 plus years ago, and crypto has a habit of relearning them. I think we can kind of front run that, or dare I say, speed run that, by addressing these things head on and like leveraging what's already been existing in the market, but simply adapting it for a 24/7 world with crypto specific nuances.
Yeah, yeah, very interesting. And so some of the things we do see in TradFi, for
Mhm.
example, futures on silver, they raised their margin requirements and things like that based
Mhm.
on some sort of threshold. I imagine prediction markets, those are probably pretty easy to do a risk engine on just because there's
Mhm.
limited downside and upside. Then once you
Mhm.
start layering options, it gets a little bit more complicated because you need volatility marks, especially when the
Mhm.
market has disappeared and fast markets. And perps are tricky as well because you don't want to get, as you said, those bad wicks where everyone gets stopped out for something that didn't really trade. How do you think about having the flexible risk engine with the flexible order matching?
Sure. So I think at least when it comes to margining and those bad picks that we were talking about, that's where I think having a robust and reliant data stream comes into play, and for which we've partnered with Chainlink and are using their data streams platform, combined with some additional internal proprietary modifications on our side. I think having measures like that combined with things like circuit breakers, right? Limit up, limit down. These are things that exist in commodities for a while and also give market makers, I think, some sense of peace of mind of, hey, if someone's snooping the order book, we can actually halt trading temporarily, let markets resume in an orderly fashion. And this is actually better for buyers and sellers, makers and takers, right? And I think not having those in crypto as to some people been a very fun thing because it's like, oh, I like this short feedback loop of just getting liquidated or having 10x profits very quickly because it's a high vol asset class. But if you actually want on-chain adoption and a multi-asset class venue, those things need to be thought about. And so I think incorporating them out of the box for traditional assets that have less on-chain liquidity is going to be a no-brainer, right? So once we incorporate equity perps or commodities perps, I think having limit up, limit down, and circuit breakers is part of the core ethos.
Yeah, it's interesting because I in traditional finance when I think of like the commodity space and I think like lean hogs have gone limit up and it's the market's closed for the rest of the day or whatever it is. That's kind of easy because there's essentially one venue and one pit, and that one venue and that one pit can close markets. When we talk about crypto, it's a distributed network of venues and
Yep.
trading. So even if your exchange goes limit up, the market is still trading outside of that, and so the market makers still have the risks. The risk is still existing out in the world. How do you think about that?
Well, I would actually argue that actually introduces more opportunity for makers, very much so, because then it just leads to cross-selling arbs, right? Like for market makers who are simply trying to capture bid offer all day long or trying to arbitrage prices, having one venue that is either lagging and having a lead lag effect, or simply is less liquid or more liquid, I think that just introduces unique arbitrage opportunities for these guys. But if the model is to build a venue that is supportive of both makers and takers and is mindful and partners with, dare I say, institutions that have a foothold in both the traditional world and the crypto native world, I think they are best positioned to do so, right? What we're trying to build ideally is not something that's simply for crypto natives, right? It's for the same people that are click trading on Robinhood or Interactive Brokers who are also applying through a terminal front end and want to have LLMs incorporated with this. This is for your average retail users. And in order to facilitate that, you need to have these measures in place while still being like, oh, well, the best participants and market makers who are able to provide liquidity are going to be the ones that have cross-venue arbitrage and can think about those decisions in highly volatile markets.
Yeah, I see what you mean. And so, like the market maker will have the opportunity to hedge between sort of the two venues, but
Yep.
your venue being limit up or limit down kind of puts a pause on like new positions being open and all that stuff, and essentially the risk that's part of the Monaco ecosystem, even though the rest of the world is still kind of open. Oh, that's very interesting. Um,
Well, the truth of the matter is, right, like an exchange should never go solvent or insolvent rather, and if it does, then that's just bad risk management at the end of
right.
the day. So the priority zero of all possible things is to make sure that everyone is made whole and the exchange doesn't go insolvent. And so the probability, I would say, of a venue like Monaco halting trading while others are still engaging is probably pretty low. And even if that were to happen, I would argue that the liquidity on those venues would already be so suboptimal that there's de minimis trading, right? So just
Mhm.
because someone else has been halted trading, that doesn't mean that trading is still actually happening because there's this huge divergence in prices.
Cool. And then what
Hmm?
chain is like what cryptocurrency chain is Monaco being developed on?
Sure. So we're actually using off-chain matching on-chain settlement, where the on-chain settlement is happening on Say. The goal is to ideally be cross-EVM compatible and really abstract away a lot of these chain-specific nuances for people to trade, right? Users shouldn't have to think about paying gas for deposits or paying gas for settlement. We want to support native minting directly from your bank account, minting USDC into your spot trading and being able to do that in, dare I say, under a minute. The North Star is very much think about how many people pay for their overpriced Starbucks with Apple Pay versus those that know actually how Apple Pay works under the hood. I would argue that's a very small minority of people.
Mhm.
And that's what we want to do for the trading experience, where most folks who are users don't really care about where the underlying settlement layer is. They simply want something that is highly performant, accessible, transparent, and delivers that unique experience catered to their trading style.
Cool, cool. So typically, Simran, I like
Mhm.
to end the podcast with kind of two questions that I ask all my podcast guests. The first one is, do you have any favorite trading books? And the second one is, you're a busy guy, but is there any hobbies that you do outside of work right now that you're passionate about?
Sure. So I'll take those in sequential order. Favorite trading book. Um, I feel like trading book in particular might be too narrow of a category, but Natenberg's options volatility trading is probably the Bible of folks who go into options trading. Even when I was an intern at Goldman, that's what was given out to everyone, or that's what everyone referenced. I think some people prefer Hall, other people prefer McDonald. Some people go to Taleb. Everyone has their own favorite author, but I think Natenberg does a pretty good job of going through basics and really building the intuition behind the math as opposed
Yeah.
to simply focusing on the math. And I think when you're sitting at a trading desk, being able to do quick mental math is useful, but not as useful as understanding what your second order and third order effects are. And so I think that is why Natenberg tends to be a pretty good source there. As opposed with reference to hobbies, I would say I tend to enjoy reading, travel, time with friends. It is a privilege to be able to do what you love and love what you do. And so if you live a life where you get to do what you love, it doesn't feel like work. I think is the core ethos. But
Yeah, for sure.
yeah,
That's like a superpower because you can't put in the hours if you don't like what you do. And if you like what you do, you can put in the hours and who can catch up. It's an unfair advantage. It's a fair, unfair advantage. So that's great.
it's
Um,
a blessing.
it's a blessing, yes. So, Simran, if anyone wants to learn more about Monaco or
Mhm,
maybe reach out about the private beta or maybe become a token partner of some sort,
mhm.
where should they go?
Sure. They can go to our website, 0xmonaco.com. They can reach out to me at Turban Urban on Telegram, at 0x Turban Urban on X or Twitter. Happy to talk to folks, get their thoughts and inputs on what we're building, and partner with key design folks to help build a really successful product and experience.
Well, thank you so much for coming on the podcast. This is Simran Singh, CEO and co founder of Monaco. Thank you so much to everyone who tuned in. We'll catch you next time.